Today we get to talk about a triple tax-free retirement weapon disguised as a boring health benefit. It's the ultimate Trojan Horse of the US tax code, wrapped in beige, hidden in plain sight. It is the health savings account. So today we're going to talk about what HSAs are, how to use them to your maximum benefit, and if they apply to all folks.
All right, so Spencer, the health savings account, HSA, it is the only triple tax advantaged account in the United States. One, what is a health savings account? And two, what do we even mean by a triple tax advantaged account?
Well, first, as we'll get to the triple tax savings, but it's almost like you had a traditional IRA and a Roth IRA, get married, have a child, but it goes to the back of your benefits folder and never gets used at all. So it's wild that this is the best type of account for certain things, and many people don't know about it. So triple tax savings, you get a tax benefit on the way in. You make a contribution that gets written off as deductible on your taxes. So let's just say you contribute $7,000 to make things easy. And let's just say that you're paying a marginal rate that is 37%. You're going to have something like $2,500 of savings there. So significant savings upfront on the way in. Those investments, if you make them in a HSA instead of just keeping it in a bank account, earning 0.3% for HSA, if you make an investment there and those resources grow, they grow tax-free, provided that you withdraw them for medical benefit, for medical expenses, I should say. So you have tax-free withdrawals. So you get a deduction on the way in, tax-free growth, and then tax-free withdrawals provided that they are qualified. So that's your triple tax benefit.
Okay, that makes sense. All right, so what are some of those requirements? You've got to be in a high deductible health plan to qualify. Are there other qualifications that you have to meet to have an HSA?
Well, again, high deductible health plan, the specifications there for 2025, you have to have a deductible of at least $1,650 for individuals or $3,300 for families. So it is a high deductible, and you've got to have an out-of-pocket max of $8,300 for an individual or $1,660 for a family there, no more than that. So basically what we're doing there is we're putting funds aside to be able to address that deductible or some of the expenses that the health plan won't be able to address. So if your health plan gives you that gold-plated PPO with no deductible, congratulations, you're not eligible.
Oh, man. All right. So you said there's contribution limits as well, just like your traditional IRA, Roth IRA. They're kind of modest, but they do add up over time. Talk us through some of those contribution limits.
So basically $4,300 in 2025 for individuals, $8,600 for families. If you are age 55 or older, then you have a $1,000 catch-up. So let's just say we have a married couple, they're in their early 60s, then they'd be able to contribute $9,600 there as a maximum level. But if we have a family of 10, you got a couple with 8 kids, and neither one of them are 55, then they could only go $8,600. And of course, again, for individuals, $4,300.
So, and it's not just you that can contribute. Your employer can contribute to this as well. Is that correct?
It is. So your employer might contribute if that's part of the benefits package. So if they've set things up in a way that they do offer a high deductible health plan, they may have this as part of their benefits package where maybe they contribute $1,000, and maybe they match your contribution up to a certain level. So you do want to make sure that you understand the trade-offs there, because sometimes they'll offer a plan that is a high deductible health plan with an HSA attached to it, where maybe they're giving you some benefit there. But then they have another PPO plan, maybe that the deductible is lower and has other types of benefits that you want to make sure you understand.
Yeah. And the one gotcha there is the contributions that your employer makes count to that annual contribution limit. So let's just presume again in 2025, if your limit for a family is $8,600, if your employer puts in $1,000, that means you can only put in $7,600. You can't contribute the full amount, and then your employer add in on top of that. It is a total amount that you can contribute between employer and employee.
Right.
Okay, let's talk about investing in the HSA. You talked about sometimes when you can open these at a bank, you might just get 0.3% because they treat it like a savings account. You can invest these funds not just in savings.
Well, and this is where most people blow it. Let's be honest. They're only getting the two benefits. They're getting the tax deduction going in, and then as they withdraw those funds, they're not having to pay tax on them. Well, this is still a nice benefit, but really that second one where we get the tax-free growth is a huge element of the overall benefit. If you're not investing your HSA, you're using a Ferrari as a lawn chair, basically.
Okay, that's an interesting illusion. So talk about how we can, if we're investing in this, it gets that tax-free growth. When should we then use our health savings account?
Well, you can use it anytime along the way that you need to. Oftentimes, if you've built your HSA into a six-figure sum, that's when you can start to think about whether you want to use it or not. HSAs can be used certainly for any of those health events, and oftentimes what we see is clients will not use them until they get closer to their retirement years, thinking, okay, I may have higher health expenses there, or in some cases you can even use those for long-term care type of expenses.
Yeah. Okay, so let's talk about reimbursements, because that kind of plays hand in hand with use it now or use it later. Let's say clients have not used their HSA over time, allowed it to grow, allowed those investments to grow. How do reimbursements work?
Well, this is where an HSA is kind of like a tax-free time capsule, because you can take these distributions out at any point. Let's just say, that I have had an HSA for many years. I make contributions over the course of 10 years, and all of a sudden I need funds to be pulled out. Maybe I need them for the extension of my deck, or closing a patio in, or something like that. If I have records that go back that can show, okay, I had this bill in 5, 6, 7 years ago, I can take a withdrawal to meet all of those needs that I did not take a withdrawal from back then. What this allows you to have is more capital growing within that HSA structure over time, tax-free, and then again, you can take those resources out as you need to. So bear in mind, you can't just take out a distribution to pay for your landscaping in your home. But if you have all of the records going back and you've not taken a distribution for any of those, then that allows you to take them for those, but use the capital for something else once it's out.
Right. So essentially what you would do there is, let's say you've got $500 of medical bills that accrue in any one year, and you're paying them out of pocket over time. Let's say you do it every year from 2010 to 2020, or whenever you started your HSA. You've got $5,000, $10,000 as the account has grown. Well, now you need a distribution, let's say, for that deck. If you've got all the records, you can show you've never pulled it out. You can pull out all those funds, reimburse yourself for those medical expenses, and then just use the funds however
correct.
You want.
That's correct.
This does seem like a cheat code.
It is a cheat code.
Okay, so let's talk about this idea of it being a secret retirement account. Why do we want to think about that as a potential secret retirement account?
Well, if you don't need the funds for medical expenses, but you're age 65 or older, you can take them out just as you would a traditional retirement account, an IRA. There, it would be a pre-tax type of investment. You get the deduction going in. If you use it for a non-medical or non-qualified expense there, then if you're at least age 65, you take it out and you got to pay tax as ordinary income on that. So if that's your worst case scenario, it's not a bad thing there either, because again, you're getting more resources into a retirement type of vehicle. And for some people, especially high income folks that would like to knock their taxes down during their working years, this can be great.
Okay. So let's talk about some of those qualified expenses that an HSA covers. Can you run us through some of those that are maybe some of the outliers? We don't just think about doctor visits. What are some of those other things that we can cover here?
Well, one of the things that especially retirees sometimes are not planning for quite as much might be dental and vision care, both of those. So if you needed a root canal, if you needed work done on your teeth, or you have a visit to an ophthalmologist that becomes surgery and becomes more expensive, maybe it's not covered by Medicare, then you have that opportunity. Hearing aids, mental health therapy, acupuncture, prescription drugs, long-term care premiums, Medicare premiums. You can pay for Part B, Part D, or Medicare Advantage premiums. Now, you can't pay for the Medicare supplements with HSA funds, but there's a whole lot that you can pay for with these HSA funds
that's
that
great.
are qualified.
That's great. All right, so I've heard of HSAs. What about FSAs? Are those the same thing?
This is the evil sister of the HSA that gets very, very confusing. An FSA is use it or lose it. You've got to use these funds by year end. It oftentimes makes an FSA just unattractive because you don't know what your expenses are going to be. And there are so many different clients that have pushed funds towards an FSA via some kind of an employer plan setup and get to December and say, well, I didn't need this year. It's surprising, but I don't. Well, they end up doing something, having a physician visit that maybe they don't, they wouldn't necessarily prioritize otherwise to just try to be able to use it, which isn't necessarily the best idea.
Right. Okay. So let's talk about the idea of portability with health savings accounts. So it may be tied to your employer. Your employer offers you a high deductible healthcare plan. You take advantage of it. What happens if you leave that employer?
Well, it follows with you. This is not something that just stays behind. The HSA is yours for life.
All right. So HSA moves with you. You leave your employer. You can move it to another custodian. What about beneficiaries? How do we want to think about the beneficiaries of an HSA?
Well, twofold here. One is if your spouse is the beneficiary, then you pass away, it goes to your spouse. There's really no differences there. Your spouse can use it for his or her expenses. And the federal government is also surprisingly chill on using these funds for your children. As long as they are your dependents, there's not a whole lot that you've got to prove there. Now, once you don't have dependents there, then using it for other types of expenses can be fraught for your friend or for your children that are not living under your roof that are no longer dependents. Those would be non-qualified types of expenses there, generally speaking. But if you have a beneficiary who is not a spouse, then upon your death, your beneficiary is going to have a tax bill that's going to be due. And it's going to be, the entire amount there is going to be considered ordinary income on as you pass there. So you do need to recognize that, but you've gotten the tax benefit up front. And so usually with HSAs as well, it's not as though they're growing at the same clip that, say, a traditional IRA or a pre-tax 401k might. So you usually don't have so many funds there that you're going to have a huge tax bill there that you're going to be passing on to beneficiaries.
Okay. So let's maybe talk about some of the pitfalls of the health savings account. Not all HSAs are created equal. So let's talk through some of those pitfalls. What are some that clients need to be aware of?
Well, sometimes an employer will set up a plan and have a very baseline level that would be mostly just a kind of a bank account offering. Might not even pay any interest there. Or you might have heard of an HSA and you set up an HSA through your credit union or local bank. Again, there might not be any investment options that are there. So there can be no growth. That second opportunity set, you might not have any growth in your HSA there, which would take away a significant piece of the appeal to it. You can also have higher annual maintenance fees, hidden investment fees, lack of options that are there. And so you really have to be careful where you hold those HSA funds. And you also want to build them to a level where you can make the investments. I mean, you don't want to just hold $1,000 in an HSA. It's really not worth your time there. But if you can put, $7,000, $8,000 a year towards HSA and then take some of those funds at least and push them towards investing within an HSA, well, now we're talking about the real benefits that you can accrue.
Yeah. All right. So Spencer, we've talked about a lot of the pros, cons, option sets that you have with an HSA. If we were to say, let's line out what is a potential way to optimize a health savings account, how would you go about doing that?
So if you want a stealth IRA with its superpowers fully engaged, fully able to help you, first enroll in a high deductible health plan. And hopefully that plan is fairly steady over time, fairly constant over time, so that you're not constantly evaluating, okay, is this other plan that's a PPO better than this high deductible health plan? If you have one that's available to you, you like this approach, then keep this consistent. You max out your HSA every year. You pay all of your medical bills out of pocket, and then you save the receipts. So like we talked about, if you'd like to come back and take distributions in 3, 5, 10 years down the road, you're able to do that. You invest the HSA as aggressively as you're comfortable with there. You let the account grow, and then you reimburse yourselves potentially decades later or whenever you might need to there. And then you use the rest for retirement costs, basically. So if you follow that approach, again, we never want to push you into an investment that you are not comfortable with. So, if you think that the stock market is incredibly risky and you don't want to ever invest there, why don't just do that with your HSA? You do have to think about your risk tolerance and all of this. But this is very similar to a Roth IRA. And if we say with clients, we tend to try to make a Roth IRA as aggressive as clients will be comfortable with. HSA the same way. We want to see as much tax-free growth as we can over time. So that's why we would encourage clients in this particular direction.
All right, so health savings accounts seem like a really great option for most folks. Obviously, there's some people that have really high annual medical bills. Are HSAs great for everybody, or who should be cautious about thinking about an HSA?
Well, you want to evaluate all of your health insurance plans. We don't want to put the cart before the horse. So if you have one plan that's available to you that is far more advantageous, go with that plan. Don't go with a health savings account plan, a high deductible health plan, if it's not going to be good for you. If you're going to have $5,000, $6,000, $10,000 more of expense by going that high deductible health plan, the tax savings offset is not going to be able to generally keep up with that. But oftentimes what we see is employers will give you multiple options, or you may have multiple options in the marketplace, and the expense going in up front is fairly comparable, but the HSA allows you to kind of stack the odds in your favor if you're able to use that.
Well, Spencer, thanks for walking us through the health savings account. Clients, if you have questions about your HSA or whether you are able to open an HSA, we would love to have that conversation with you. And as always, if you have any questions, feel free to leave them in the comments below. We look forward to seeing you next time. Take care. If you like these financial planning videos, please share it with a friend. And if you have questions, go to our website at SiriusRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SiriusRetirement.com. The information in this recording is intended for general educational and informational purposes only and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.